Now, while it was an overall inline set of numbers when you're looking at Q2, in fact, top line as well as EBITDA to some extent was in line. Margins saw a bit of compression, around 20 bips thereabouts. Mr. Joseph, hi, good morning. This is Harsh here. Let me take it straight to that margin number. Some compression, you see that as temporary? Would that unwind fairly quickly? Is that at all a concern or a lens into how you're looking at Q3 and H2 FY26? Give us a sense to that first.
Well, Harsh, good morning, and thanks for having me. I think when you look at our sales performance, it's steadily been increasing. We went to 9%, then followed it up with a 10%, and now we're at a 12% growth the last quarter. And like you rightly said, our earnings have stayed in line with it. When we look at the standalone numbers, the EBITDA runs about the same as last year, and very much in line with how we see our guidance. So as we guide to the future, and not necessarily one quarter, Harsh, but over a period of time, we're quite comfortable with the 15% growth that we've always put out there, along with a 15% PAT. And the numbers are all very much in line with that. So I'm actually quite pleased with the quarter. As you know, last quarter is usually a time of clearance sales for us. We were able to clear out the goods we needed to, and yet increase our gross margin by about 40 bips. So that's also exciting that we didn't have to overly discount to drive that revenue.
Mr. Joseph, Sajid here. Can you also take us through the kind of tailwind that you may see because of the GST rate cut, and how was the last half of September, and where some of the sales pushed over to October in that sense?
Yeah, so I think thanks for asking that question. It's been a very exciting time for us. The GST reductions have actually helped us across all the price points that we have underneath 2,500. So we didn't see any of our GST go up. On the contrary, we had anywhere from a 6% to 11% reduction in prices thanks to the GST. There's about 40% of our goods in total as a company, and I'm counting all our banners, that are going to be positively impacted by the lower GST. So that's very good. To answer your question about the back half of September, it continued to gain momentum, but it was also driven not only by the GST reductions, but also by the fact that, Diwali is a little bit closer this year. So you're going to see some positive impact from that. And that was a good tailwind that we had.
And how was the volumes in terms of growth for you in Q2? And do you expect Q3 to be a better one because of the kind of tailwind which is coming in for you?
Yeah. So, I don't know if you've noticed or picked up that we opened 10 Walkway stores in the last quarter, which is the highest number of Walkway stores we've opened in any quarter in its history. So that's also comes at a much lower price point. However, we're seeing incredible volume growth at in that banner. The other banners continue to perform very much in line with the rest of our sales projections.
Mr. Joseph, I know your guidance is 15%, but would one at all expect that growth clip to go up, especially temporarily in FY26, just given the fact that you've got this GST rate rationalization tailwind coming through? Would that number likely surprise on the upside? Give us a sense. Of course, you don't have the real numbers as of now. It's just a month since the rationalization. But give us a sense on how you think of it and whether there is a possibility of upside there.
Well, I think anytime there's a good elasticity between price and demand. So we expect a positive impact from that for sure. What's more important, I think, is we're over the bumpiness and the lumpiness of the post-COVID era. There are nothing that is of a nature that would be offsetting for this coming quarter. There's about an equal number of wedding dates as we had last year. All of it looks like it should align to where the GST benefit should be an added plus on top of all of that.
What's the target like for the expansion of stores for the remaining part of the financial year? You said you opened around 10 stores in the quarter. So for Q3 and Q4, what's the kind of target that you have?
Yeah, so we actually opened 42 new stores in this quarter. What I was alluding to was that 10 of them were Walkway stores. It was a net of 38, and year to date, we've opened 58 stores. I think what you'll notice there is that we've started to accelerate our store openings again, and we're quite excited by seeing that the economy is starting to uptick. We've had almost 3/4 of double-digit growth. So that gives us the confidence to continue to keep our expansion. We try not to get fixated on a target for growth, but we're fixated on opening as many stores as makes financial sense.
And Mr. Joseph, how's the other channel doing? E-commerce, quick commerce. You've obviously guided for a ramp up with regard to the contribution of e-commerce to total top line, and it's growing at a fairly healthy clip. What are the early trends indicating? Are you going to get there? Could you exceed that number in terms of e-commerce and quick commerce? And what is post the GST rationalization? What's the kind of absorption, or is there a trend change that you're witnessing? Are more people looking at stores or at e-com? Give us that sense.
Yeah, I know. I think it's still early days to make predictions against what the trend is changing, right? If you see a blip here and there, you're only talking days of blip, so it's not a major trend yet. What we see is our investments in the digital commerce space is starting to pay off. We've built considerable talent. We've made considerable investments financially in tech to help our e-commerce business grow and grow. It's maintained a healthy clip, but what I'm really more excited about that growth is it's coming at a profitable level. And as you know, in the e-com space, not a lot of people can brag about profitability in the e-com space. Do I see it continuing? Absolutely. Do I see it in any way taken away from the brick and mortar experience that consumers like? Consumers like trying on shoes, they like shopping, they like being out there. I don't see that changing. And as you can tell from our growth, while e-commerce has grown at a slightly faster clip than the rest of our business, it's not that the rest of our business has been lagging, right? So e-commerce is now at about 14% of our business. So it's not a significantly big portion. So I expect it to continue to grow, maybe even get some more share of business, but it's going to be done at a very profitable level. And we're not here to just drive the heck out of e-com sales at any price.
Mr. Joseph, if I can get you to comment on what's the kind of takeaway that you have seen from your sales on the quick commerce website platforms like a Zepto or any other platform. Is there a particular brand or particular price points which are more saleable on those platforms for you?
Yeah, I think we've been quite pleasantly surprised by what people will buy on quick commerce, right? And I think the consumer is going to expect to see more and more of an array out there. But it's not really different from your typical, goodness, I need something quick. It's not one of those thought out shoes that people are buying. It's one of those, I need a party shoe, I need a wedding shoe, I need a flip flop, I need a handbag to match my outfit this evening. So there's a lot of that impulse buy coming, which is what's exciting because you and I know impulse is typically accretive to your sales.
And Mr. Joseph, new brands that you are working with, you've already launched something like a Clarksfeel, Footlocker as well, New Era, Walkway. How are they performing? And give us a sense into any new partnerships that you are likely to enter into, anything in the pipeline?
Yeah, so we're very pleased. We opened 4 Footlocker stores last quarter, which is very exciting. And, we'll continue to grow that chain. I think the Footlocker growth has been slightly muted compared to what we would like, primarily because of the BIS regulations that, put a little bit of a hiccup in the supply chain for our brand partners, but, they're catching up to it. And as they catch up, you will see us accelerate the growth of Footlocker stores. Clarks has been a terrific addition to our portfolio. We've launched it in 200 doors. It's done extremely well, and we're quite pleased with it. As far as new brands or other brands, we're always out there making sure that we're catering to what our customers are looking for. So it's really not from what we want to do. It's really what our customers are telling us they would like to see us carry. And, being a national retailer, being a well-organized and well-run retail operation, consumers look to us to fulfill their footwear needs.
Sure. And what about BIS normalization? How has that impacted your numbers, if at all? And obviously, give us a sense on the supply chain issues as well, which could come up.
Yeah, so different banners in our portfolio have been affected differently, right? So Walkway has not been affected at all because we were sourcing all our products domestically. At Metro, we were sourcing about 15% of our products from global factories. Some of them have got certified, some of them have not got certified, where we've had to find alternate sources on how to procure that product in India. The Footlocker brand relies heavily on external brands to provide the shoes, and each of those brands are at a different journey, at a different point in their journey on BIS mitigation. So it's been a little bit of a mixed bag. The good news is I think we're seeing light at the end of the tunnel on this BIS mitigation process, and that should help us as we go forward.
All right. Thank you, Mr. Joseph, for coming in, speaking so candidly. And it's always great chatting with you. Thanks
Great.
for coming in and speaking with us. Some of the retail